Hi, everyone. I'm David Silver, CEO of Instrumental Wealth, and joining me today is Matt Harbert, Chief Investment Officer at Instrumental Wealth. And today we're here to discuss all the things that took place with the markets and the economy in Q3 of 2024. So, Matt, we have a lot to jump into. So let me go ahead and kick this over to you, and we'll jump right into things with what went on with markets in the third quarter.
Sure. Thank you, Dave. Okay, so starting with the investment markets, there were a few themes over the third quarter. We did see some change in leadership of the top performing markets. Some volatility increased in the U.S. large cap equities. We'll look at performance versus value versus growth, as well as performance of the Magnificent Seven stocks in the S&P 500. So starting with the broad equity markets, you can see overall, looking at the chart, markets did pretty well over the third quarter, but there was some change in leadership here. You can start first by looking at the green line and the pink line, which is the international stocks. They actually outperformed the U.S. stocks. You can see that looking at the Russell 3000 return, which is only 6% versus the EFA at 7% and emerging markets at 8.6%. Emerging markets actually did continue some strength that started in the second quarter. You can see they actually outperformed the foreign developed markets. They were really helped. There was some stimulus that the Chinese policymakers made to their economy, and that really gave a boost to emerging market stocks as well. Surprisingly, the U.S. small cap stocks actually surged over this quarter, and they became the top performing equity class. You can see that by the S&P 500 return, which is a light blue line on here, and it performed a little over 11% for the quarter. Now, if we look at year-to-date performance, though, there really hasn't been a lot of change in these leaders. So in this case, you can see U.S. stocks looking at the Russell 3000 and the S&P 500 have continued to be the leader by a long shot. The Russell 2000 is at 20%, and the S&P 500 grew by a little over 22% over that quarter. Small cap stocks, they do continue to lag over the quarter. The S&P 600 came in at 9.3%. Really, the only change here we talked about a little bit, and that's in the international indexes, where emerging market did surpass the foreign developed markets. You can see that with the emerging markets at 16.8% versus the EFA at 12.9%. When we look at the markets and how they're compared to their all-time highs, really over the quarter, just about all of the markets were trading very close to their all-time highs. The only exception really is in emerging markets. So even with the strength we just discussed that they had over the past 2 quarters, they're still trying to recover from big declines they had back in 2021 and 2022. So one of the other themes that we talked about was volatility in the U.S. large caps. So this chart shows the VIX. The VIX basically gives us the implied volatility of the S&P 500. And you can see that spike that occurred back in August. It was really driven by some disappointing employment data that came out. There was a big revision to the job creation numbers, and that drove some uncertainty and concern that maybe the Fed had been waiting too long to start their easing policy. But later in the quarter, back out in September, when the Fed actually cut rates, you can see that did drive that volatility down, but it does still remain a little above average. You can see it's sitting at 16.7 versus the average at just about 15. So while it's close, it's still slightly elevated right now. Now, expanding out and looking at markets outside of just the equity markets. Again, here you can also see most markets did pretty well over the third quarter, but a similar story, a lot of those top performers were actually previously laggards. So you have real estate that is the top performer for the quarter, and they really had a boost from that some falling mortgage rates, so that helped that out a little bit. And also value. Value has been lagging consistently, and that had a pretty strong quarter, coming in at the third best asset class, even outperforming growth. Although year to date, it does still lag growth by about 800 basis points. And here you can also see the big increase in U.S. small caps. So U.S. small caps grew by 9.3%, which puts it at the fourth best performing asset class in the quarter. So it's really, when you look at all the different asset classes, really commodities are the one asset class that struggle a little bit, remain essentially flat at 0.7% for the quarter. So I talked a little bit about how value outperformed growth. This chart, it's a little bit busy, but what this gives us is quarter by quarter, the relative returns of each of these asset classes. And you can see in the current quarter, which is the column all the way to the left, the orange square is US value, and the dark blue square is US growth. And you can see in this case, it's showing value relative to these asset classes is the second best performer, while growth is the third worst performer. Now, interesting, this is the first time, the first quarter that value has actually been able to outperform growth, going all the way back to the fourth quarter of 2022. Surprisingly enough, if you look in the middle of the chart, you'll see the column that says 12/31/2022. That is the last time that value outperformed. And interestingly, they're in the same positions. Value is also the second best performing asset class back then, and growth was also the third worst performing asset class back then. But nonetheless, it shows that it's been the first time in nearly 2 years that value has been able to turn the tables and outperform growth. You can also see this isn't just just to large caps or one particular area. This is actually across and consistent across all of the different market caps. So these benchmarks on here, you'll see the Russell 2000 is for small caps, and the Russell 1000 is large caps. And in this case, you'll see both the 2000 value and the 1000 value are outperforming both the 2000 growth and the 1000 growth. So for this quarter, not only did value outperform, but it was consistent across all of the different market classes. And that takes us to the Magnificent Seven in the S&P 500. We have been talking quite a bit about the Magnificent Seven over the last year because they have essentially outpaced the other 493 stocks in the S&P 500 by a pretty astronomical amount. But the question is, are we beginning to see an end of this trend? How have they done in the third quarter? So kind of starting first with what's driven a lot of this outperformance is earnings. So this chart, we're going to focus on the gray bars, which is the Mag 7, and the green bars, which is the other 493. So the left part of the chart will show us earnings growth for each of these categories for 2023. And you can see that outperformance really was justified as the Mag 7 companies grew by over 34% in 2023, while the remaining 493 companies, actually their earnings declined by almost 4.5%. Now moving to the middle part of the chart, the Mag 7 continues to be around that 34% growth rate for their earnings. But we did see a significant improvement from the remaining 493 companies. So they grew from falling 4.5% in 2023 to estimated by the end of this year will have grown about 5%. Now, moving on to the right part of the chart, this shows us estimation for 2025. And this is where the expectation is that earnings growth will converge between the 493 companies and the Magnificent Seven. So you can see the expectation is still there'll be a slight advantage to the Mag 7 earning about 19% earning growth, while the remaining 493 moves up a lot closer to just about 14%. So there'll still be a slight growth improvement of the Mag 7 over the others, but very close. So overall expectations are for that earnings advantage of the Magnificent Seven to really dissipate as we get to the end of next year. And looking at how the Mag 7 performance has been compared to the remaining 493, and we talked about how it's been an astronomical difference between the two over the last couple of years. And you can see that on here. The green line is the Mag 7. The blue line is the remaining 493 companies. And since January of last year, the Mag 7 prices have increased 199% compared to only 32% of the remaining companies in the index. Year to date, similar story, the Mag 7 up 44%, with the remaining up only 17%. But for the third quarter, for the first time, we actually saw this change. So the remaining 493 companies actually earned, they appreciated 7%, while the Mag 7 only appreciated 5%. So we actually did see, for the first time in 2 years, the Mag 7 lag the remaining 493 companies. Now, lastly, one of the impacts that outperformance has had, and we've talked about this in the past as well, and that's the concentration of the index. So these two charts are essentially the same chart. They're showing the top 10 holdings and what percentage they make up of the index. The only difference is the left one goes all the way back to 1989, which is when the data for this was started recording, and the right chart goes back 5 years. So you can see how this outperformance has, this is partly the Mag 7, but also kind of a previous iteration of it we called it the FANGs, mostly the same companies, a couple added for the Mag 7. But you can see how this outperformance has really driven up the concentration in the S&P 500, where the left chart, you can see it's as high as it's ever been since recorded data. But the other thing that we can see is towards the end, you can see there's a little bit of dip there. So in the third quarter, this concentration actually did fall a little bit. So at the end of the second quarter, it was around 36%. In the end of this quarter, it's sitting around 34%. So while it's not a huge drop, overall, if the earnings do start to converge towards the end of next year, but we should see that performance gap continue to narrow, potentially even more outperformance of the other companies outside of that Mag 7. and we should see this concentration start to trend more to a reasonable level.
Matt, that's great. So many great takeaways in there. Particularly something to pay attention to there on the Mag 7, which has continued to sort of be in the headlines for the last several years. Perhaps this is the beginning of the end for their reign and dominance, but certainly a lot of great details. Let's change gears and talk about the economy as a whole. Of course, the whole idea of soft landing, hard landing, where are we at? Is the Fed going to be successful? Continues to be in the headlines. Lots to unpack there. Let's change gears and have you talk through the economy and what data points you're seeing.
Sure. Okay. So kind of the big topics in the third quarter for the economy really were inflation, employment, and Fed policy. And then we'll also talk a little bit about, probability of a recession as well. But starting with inflation. So I've got two charts on here. If we first look at the one in the upper left, that is the CPI. You can see the purple line is the headline, the orange line is the core. And you can see how it is significantly come down from its peak. So it's definitely trending towards that 2% target that the Fed has. So currently the headline is sitting at about 2.5%, and the core is still actually elevated at 3.25%. However, the Fed actually, their preferred metric to look at for their policy decisions is the PCE index. And that's what I have on the right chart. Also, that purple line is the headline PCE, and the orange line is the core PCE. But you can see, looking at the PCE, that we're actually seeing even closer to that 2% target that the Fed has. So the headline is actually sitting at 2.1%, with the core at 2.65%. So you can definitely see overall inflation has been cooling. It's trending down. Both the CPI and the PCE are coming close to that 2% target, with the Fed's preferred metric really right about at that point. So it's come very, very close. If we look at the CPI and the underlying kind of broad categories, you see the right two columns on here, the month over month for September and the year over year as well. Here we can see kind of where the standouts are. So on the top part, the green is energy. And you can see that's really been where the big kind of deflationary part of prices have been occurring. So energy for the month of September was actually down 1.9%. But year over year, it's down 6.8%. And you can see below that, gasoline, that's really driven that. So we've seen a big reduction in gas prices, and that's really helped bring that overall energy category down. So gasoline in September was down 4%, and it's down 15.3% year over year. Now, the flip side to that, where the challenges remain, is down towards the bottom in that core services area. You can see where it says services less energy services. Those are the core services, and that's really been what's remained sticky and has been very difficult to bring down. And you can see particularly shelter. It's been down 4.9% year over year. You can also see below that transportation services are down 8.5%. Now, that being said, shelter really is the biggest concern because it makes up 36% of this index. So it's the biggest component by far in the CPI. So with inflation remaining very sticky there, it has the biggest impact on the overall number. So that's been one of the biggest challenges to kind of get over that hurdle to bring that down the rest of the way to that 2%. And this chart kind of shows you the same information. It's a little bit easier to see here which components are helping or hurting and have the biggest impact on inflation. So you can see the green bars, those are energy. So if it's below that zero line, that's actually deflation. And if it's above the line, that's prices are rising, they're positive. So you can see going back to January 23, just for the most part, energy has been a deflationary part of the overall CPI number. Starting at the beginning of this year, core goods became deflationary. So you can see each of the months so far this year, core goods have actually been bringing prices down. But on the positive side, or on the bringing inflationary side of it, there's been some other benefits as well. While food at home is still positive, you can see how much the actual amount that it's contributing has been falling. So it's not negative, it's not deflationary yet, but it's really gone down significantly. You can see prior to January 23, those purple bars are, they're pretty significant in their contribution to that number. But as we go through, that's really just become barely an impact at all. You've got dining. Dining still is, contributing a fair amount to overall inflation. But again, you can see compared to pre-January 23, the amount is actually come down a fair amount. So it's still impactful, but it's definitely on its way and trending better. One area that isn't trending better is auto insurance. That's that sort of reddish bars there, maroon. And you can see prior to 23, it was actually a lot lower. So it's actually been growing a little bit. So that's probably the one area that's been increasing over time on the overall number. And then lastly, as we talked about shelter, that's dark blue bars. You can see that has been very consistent and very sticky, and it remains the biggest impact to inflation. So, so that's what's driving those numbers right now. But one thing that is pretty interesting is if you look at the CPI over time. So this is going back to 1965, and this is showing where the CPI has been. And this current drop, you see to the right, that current drop is actually the largest drop we've seen in the past 60 years that is not in a recession. You can see the primarily all of these other big falls occur where those gray bars are. And those gray bars are the recession periods. And each of those big falls are really occurring during recessionary periods. So this is kind of unusual that we're seeing this big decline and we're not in a recession right now. So that said, the Fed. So the Fed actually is tasked with two mandates. And we've just been talking about one of them, and that is stable prices. So one of the Fed's mandates is to keep prices stable. And that's why they have that 2% target. That's where they think is the optimal range of inflation to be at. But the other mandate they have is full employment. So they're actually tasked to have not only stable prices, but to have full employment. And they have been really focused on the inflation side for obvious reasons over the last couple of years. But now that inflation has been cooling and coming very close to their target, they've actually kind of shifted their focus over to the employment side of the mandate. So when we look at employment, what we can see is the labor market has actually also been cooling for most of the year. So if you look at the upper left, the job openings, you can see it has been trending downward. On the bottom right chart with unemployment, you can see unemployment has been coming back up. And I don't have this as a chart on here, but in the various consumer surveys out there that have kind of that sentiment on job conditions, we're also seeing weakening in those various surveys as well. So consumers are actually kind of seeing that job conditions, they feel they're getting a little worse as well. Looking at the labor demand part of this, if we look on the left, you see both openings on top and hires in the middle have both been falling. Hires have actually hit right around their 20-year average, although openings are still elevated at this point. If we look on the right side for the employment situation, we talked already that new jobs were significantly revised downward earlier in the quarter. Just to note, though, this is a preliminary reading, and they're going to be revising that going forward. So it is very possible this could be revised upward as we go through the year. We'll just have to keep an eye on that. But even after the revision, there have been a robust number of jobs added this year. Although we did get last week's employment number since we put this together, and it came in actually pretty weak. So we may be this may not look as strong as we initially had when we put this together. Again, we'll want to keep an eye on that, but the most current reading that came out since we put this together is quite a bit lower. Lastly, the unemployment rate, you can see that's come up quite a bit. It was at a low of 3.5% or 3.4%. Is currently sitting at 4.1%. Just to note, that is actually still below the average rate of 4.72%. So we can also see a similar story here. This is the ratio of job openings to unemployed people. So essentially, it's sitting currently, there are 1.13 jobs for every job searcher. And actually, if you look at the chart carefully, you can see that that current rate is actually lower than it was just prior to the pandemic back at the end of 2019. Looking a little bit more long-term at job creation, this chart shows us the month-to-month changes in non-farm payrolls. So similar to the other chart, the bars are recessionary periods. And that to the right, where you see that blue bar in there, that's kind of our current period. So you can see how much job openings or job creation have come down over the past few years. So it's come down quite a bit. But in a longer term perspective, two things kind of can be pointed out here. One is it's currently sitting at right around where it was during the previous economic expansion from 2009 up to 2019. So it's come down significantly, but it's still kind of in that same area it was previously. Also, if you look at all of the recessionary periods, every one of them have a big drop in negative, significantly negative. So at this time, we're not seeing kind of that the recession type look of heavy negative job creation. So overall, employment has softened considerably. It hasn't collapsed. So there is still some strength in the system. So getting to Fed policy, while the labor market is still showing signs of strength, The Fed has actually communicated the concern that there is now, according to them, more risk to a continued deterioration of the employment side than there is to rising prices. So that really is what drove them to begin the easing cycle. So they ended up cutting rates for the first time this cycle in their September meeting. Now, everybody pretty much expected that they were going to cut rates in that meeting. There was quite a bit of debate whether it was going to be 25 basis point cut or a 50 basis point cut. And they actually chose to go with the more aggressive 50 basis point cut over that meeting. Now, we kind of felt that maybe a 25 basis point cut was more appropriate, given the economy was still, fairly robust and strong. So there was no rush to be too aggressive. They could have, we felt they could have cut a little bit slower, kind of see how the markets and everything react to that, and then, continue with cuts later on, dependent on that. Also, that the larger cut does add a little bit more risk of reheating the economy and thus potentially put some pressure on prices coming back up again. So they did go with the 50 basis point cut. We felt kind of maybe 25 would have been more appropriate. But they did go with that 50 basis point cut. But going forward, what do we expect the Fed to maybe do by the end of the year? So this chart gives us both what the federal funds target has been, and then to the right, you'll see where those diamonds come in. Those are estimates going forward. So looking at the blue diamond, that's based on the Fed dot plot, and that's where each of the Fed members give what they think, where they think rates should be at these periods in time. So at the end of 2024, based on what the Fed members feel interest rates should be, you can see the first blue diamond is at 4.4%. So that's the mid-range of the target that they feel rate should be. So that gives us a range of 4.25% to 4.5%. That's where they feel at this time they feel rate should be at the end of 2024. So there are two meetings left, one in November, one in December. So that implies there will be a 50 basis point cut in rates by the end of the year. That could end up being, if that's accurate, one cut in one of those meetings of 50 basis points, or a 25 basis point cut in each of those meetings. When we look at kind of what's being projected out there by the markets, this shows us the probability in the November meeting where markets feel rates are going to be. So they're essentially showing a 95% probability of a 25 basis point cut in November. They actually have a 5% probability that the Fed will pause, and there's no probability of a 50 basis point cut. I don't have the chart up here, but if we looked at this for the December meeting, it actually is showing a 75% probability of rates going down to 4.25% to 4.5%. So that's that full 50 basis point cut by the December meeting. So essentially, the overwhelming projections here are for two 25 basis point cuts, one in November and one in December. So that gets us into potential recession and what we're looking at as far as GDP growth for the economy. And this table shows us the past 5 quarters of GDP, and you can see we just got the final estimate for the second quarter of 2024 GDP growth. And while we were seeing a softening earlier in the year with GDP falling down to 1.6% in the first quarter, we saw a good rebound in the second quarter up to 3%. And that was really driven by personal consumption. You can see that in the second line with the colors on it, where in the first quarter, consumption had fallen from 3.5% in fourth quarter last year to 1.9% in the first quarter, and then had a pretty strong rebound for the second quarter, almost a full percent, up to 2.8%. So we still are seeing some decent strength in GDP. And since we put this together, we did actually get the first estimate for the third quarter GDP. Results were a little mixed. It did fall slightly. So the third quarter GDP, the first estimate was at 2.8%. So it did fall down a little bit, but there was actually a big spike in personal consumption. It went up almost another full percent to 3.7% growth. So primarily that fall was a drop in private investment, which fell from 8.3% to just 0.3%. But keep in mind that our economy is a consumption-based economy, so that personal consumption really drives a big part of that overall growth to GDP. So really what this tells us, with spending continuing to be pretty strong, being in a consumption-based economy, it does sort of hint that we're, looking at possibly getting that soft landing we're hoping for.
That's great.
Now, recession probabilities, I've put this table up in the past before. These are our traditional indicators of a recession. So what are they telling us? The yield curve has continued to be inverted. This is the 10-year to 3-month, which is what is typically looked at as that inflation indicator. It's been inverted for 24 months. So it's flashing red for a recession. The LEI index, which is based on forward-looking economic indicators, it has kind of dipped back and forth, but it's flashing red for recession currently. And then the SAM rule, which is based on unemployment, it's also flashing red for recession. It's actually the second quarter that's done that. So the only indicator really not giving us a either warning or imminent recession sign is the Chevet and Peger. So overall, these indicators are pointing out that we should be heading into a recession, but they've been doing this for quite some time. So are they just crying wolf? That's the question. So if we look at some other areas, these are cyclical sectors that JP Morgan has done some research that their feeling is that if there's going to be sort of an external shock to the system that could put us into a recession, it is typically because there has been a bubble or an excess in one of these four cyclical sectors. And if you look at these, there's nothing here that's really showing an excess. So residential and vehicle sales are pretty close to their averages. Home building doesn't look excessive. The consumer still looks in decent shape. Business spending is reasonable, and inventories aren't over accumulated. So nothing here really suggests a bubble in one of these areas. So there doesn't seem to be a high probability of an external shock putting us into a recession. But also if we look at corporate profits, so this chart, the dotted line is the start of a recession. And the black line looks at corporate profits in those periods heading up to that recession and just after. And you can see really corporate profits leading into a recession are generally falling. And, just before the recession actually turned negative. So the green line is where we are currently. And we've actually seen an increase in profits. So nothing in corporate profits is actually uh, acting like we would expect it to act prior to a recession. So profits don't seem to be uh, hinting that we should be entering into a recession right now. And then looking at this chart, Fidelity puts this chart together. It's their estimate of where we are in the business cycle. Um, just want to point out that, a recession is actually a normal course of the business cycle. So it is one of the stages in the cycle. And, it's something we should expect we would enter at some point. But question is, how close are we to that? And this is an interesting chart because this shows quarter one and quarter two, and three and four are on top of each other. So there you don't see three because it's actually sitting underneath the quarter four. But Fidelity actually had us really close to entering that recession in the first quarter. But as we showed, GDP has improved. We've seen consumption improve. There have been other indicators that have improved. So they've adjusted that. And in the second quarter, they actually adjusted that and felt we were closer to the middle of the late stage. And then in the third quarter, things improved even more. And they actually put us into essentially just entering the late stage of the cycle. So really, this also suggests that we have some time left before we enter that recession stage. So it does appear that potentially those indicators are crying wolf. When you look at the external factors, like the cyclical sectors, nothing in there seem to be out of whack that could put us in. Profits look strong, so they don't appear to be deteriorating to the point that we should be expecting a recession. And as far as the stage we're in, looks like we're early, late stage, so we're have a little bit of runway ahead of us before we get into that recession period. Looking at that late stage, this is another part of the research that Fidelity does that is actually kind of interesting. It looks at how different broad asset classes, equities, fixed income, and cash have done in each of these stages. If we look at the late stage, given that's where we are now or projected that we are right now, really you're not seeing any one of the three having an advantage over their other. They're all very, very close to the same performance in that stage. So, that really implies that, if we're looking at allocation across these asset classes, really a neutral allocation probably makes the most sense here. You wouldn't want to take big bets. Maybe one thing you'd want to consider is as we kind of move through that late stage, potentially consider some overweight to fixed income, kind of preparing for that time we do enter into the recession. As fixed income, really that's where the outperformance for fixed income is in those recessionary periods.
That's great data and really insightful in a lot of different areas in really sort of unpacking what our clients are probably hearing in the headlines on their favorite media source. So that's really great to unpack that. A lot of great key points. Let me turn it back over to you, and we'll just kind of bullet point out our key takeaways here from the presentation.
Okay. Okay. So looking at the economy, inflation, it continues its trend towards the 2% target. It may take a little longer than expected to actually, get over that final hurdle to the 2% target, especially if the Fed does continue to be more aggressive on its rate cuts than we expect. And core services do continue to be a sticking point on inflation. Looking at employment, employment has been softening, but it's more of a normalizing than it is a collapsing at this point, as it still does show some areas of strength. Fed policy, they did start their easing in September, reducing rates at 50 basis points, which was a little bit more aggressive than arguably we feel was needed. And expectations going forward are of 2 more 25 basis point cuts. Economic growth, we've seen some solid GDP estimates in the third quarter, held up by strong consumer spending. The recession indicators do appear to be crying wolf, as we see solid consumer spending, corporate profits are good. There's little excesses or no excesses in the cyclical sectors, and the economy appears to be kind of just in the early part of the late stage of the cycle. Turning to the markets, the equities have remained strong, but there has been a change in leaders, with value outperforming growth for the first time since 2022. The Magnificent Seven underperformed the remaining 493 stocks in the S&P for the first time in quite some time. And potentially earnings could be converging over the next year, which could help reduce some of that concentration that we're seeing with the top 10 stocks in the overall benchmark. Allocation, looking at us being in the late stage, allocation does imply that we'll see similar returns between the broad asset classes. So that would suggest we take minimal bets, with maybe the exception as we think we're getting later on in that stage to look at overweighting fixed income to kind of prepare for that recession stage of the cycle.
Awesome. Matt, thank you. I know our clients love to get some nuggets of wisdom from you. So thank you for taking the time to put this together for everybody. For those of you watching, if you have questions for Matt, please feel free to hop on our website, schedule some time with him or your advisor. Happy to unpack any questions that you might have there. Also, be on the lookout for more from us as we get through the presidential election in the fourth quarter here. Be on the lookout for some more commentary. So thanks, everybody, for joining us, and we look forward to our next conversation. Have a great day.